Hey everyone. Today I'm diving into one of the most fascinating financial bets ever made. Warren Buffett's million-dollar wager against Wall Street's best hedge funds. Back in 2007, Buffett, the legendary investor and CEO of Berkshire Hathaway, made a bold move. He bet $1 million that a simple S&P 500 index fund would outperform a carefully selected fund of hedge funds over a decade. This wasn't just about money, it was a challenge to the high fees and complex strategies that hedge funds boast about. Buffett's point was simple. Most investors are better off in a low-cost S&P 500 index fund than in high-fee alternative investments. Enter Ted Seeds of Protege Partners, who accepted the challenge. Buffett chose to invest in the Vanguard 500 index fund, Admiral Shares VFIX, while Seeds picked 5 funds of funds portfolios investing in multiple hedge funds for diversification and access to top managers. The bet started on January 1st, 2008, and talk about timing. The financial crisis hit soon after. Initially, the hedge funds had an edge, using their strategies to cushion the blow better than the S&P 500. But as the market rebounded, the index fund's simplicity and low costs shone through. By the end of the 10-year period, Buffett's S&P 500 index fund had an annualized return of 7%, while the hedge funds managed just 2.2%. By 2017, Buffett had won hands down. This victory wasn't just about beating Wall Street, it was a powerful endorsement of passive investing. Wall Street often markets hedge funds as a way to reduce risk and boost returns, but Buffett proved that fees matter. Hedge funds typically charge a 2 and 20 fee structure. 2% of assets and 20% of profits, which eats into long-term returns. Buffett has always argued that most investors should stick to low-cost index funds instead of trying to beat the market. His win reinforced that high-fee, complex strategies rarely outperform simple, low-cost investing over time. And what about the prize? True to his philanthropic spirit, Buffett directed the $1 million prize to Girls Inc. of Omaha, Nebraska, a non-profit he has long supported. Initially invested in zero-coupon treasury bonds, the stake grew faster than expected and was converted into Berkshire Hathaway Class B shares, worth significantly more by the end of the bet. Warren Buffett's million-dollar bet is a case study in the ongoing debate between active and passive investing. It underscores the importance of keeping investment costs low and highlights the difficulty of consistently beating the market, too. For most investors, Buffett's advice is clear. Stick with low-cost index funds and avoid high-fee, complex investment strategies. Thanks for watching. See you next time. Check out danmahoneyOnInvesting.com for more info on the Buffett way to invest.